I think that China obviously has grown very rapidly in the past 30, 40 years. And there have been two major engines of economic growth. One is fixed asset investments, representing typically about 40 to 45% of GDP year after year. And that is because China has the highest savings rate in the world, about 45% of GDP. And in economics, of course, savings rate typically equals investment rate. And that's why China has been able to invest so much, propelling economic growth. The other engine is export. And China, of course, is the biggest trading nation in the world. But I don't think that this growth model, since 20 years ago, I espoused the view that this growth model is sustainable. The reason for that is savings rate is going to drop with the aging of the Chinese population, with the change in demographics. China has been a very big export engine in the past many decades. But China was weaning itself from dependence on exports. If export as a percentage of GDP decreases, then what will propel China's economic growth going forward? And the answer is private consumption. So China's private consumption represents, as a percentage of GDP, is only about half that of the United States. So if China wants to sustain its economic growth, we will have to shift from exports, investments, to private consumption. As we know, in the past 3 years, housing prices were dropping, and dropping big time. So people feel this negative wealth effect, and that's why they don't spend as much. And therefore, there's a need for policy makers to stabilize the housing sector, to reverse the trend of declining housing prices. That would provide the impetus for people to consume. Only by stimulating domestic demand can firms start to sell to the domestic market, which will be good for China. If the external environment, export market, has become more difficult or more hostile, then there's no choice but for China to use its macroeconomic tools to stabilize the property sector to boost domestic consumption. China has more macroeconomic policy space than any other major economy in the world. On the monetary side, China has the highest real interest rate than all the other major economies. On the fiscal side, China is the only major economy to have net asset position, not net position, on the government balance sheet. And therefore, it has a lot of room to expand on the fiscal side. I think that the government will have to send a very strong signal with its macroeconomic policies, both on the monetary side and on the fiscal side, that they really mean business to revive the economy, to restore confidence, and then people will start to spend. And so I think that China has a lot of potential to increase private consumption.
So looking after a very big private equity firm. So I have to ask him a question about investment. Now, given this backdrop, if we are looking for opportunities in the mainland in terms of investment, no matter whether it's public market, private market, I don't want you to name company, but is it the time that we should continue to sit through a little bit to see the confidence coming back, or in this environment, you still see opportunity in particular area, and there are areas we really need to move in quickly, otherwise when the green shoots come, it might be too late to get into the market? What are your views on this?
When it comes to investment, I'm private equity investor, but I focus only on buyouts. I think for buyouts, it's very much a buyer's market. The reason is, I talked about different types of private equity investors. 90% of the capital, private equity capital that goes into China, goes into venture and growth. And for that 90%, it's very much hobbled by the market because the capital market has come down, so valuation has come down for their existing portfolios. And then IPO has largely stopped, especially in China. On top of that, there's geopolitics. Geopolitics means many of the Western investors will not invest in China. And there's also talk about whether or not China is investable, especially during the COVID years.
Mm-hmm.
But for the buyout markets, exit has not been the issue. The reason for that is if you control the company, then you don't rely on IPO to get out of the company. In fact, in my 25 years in private equity, very rarely did I exit through the public market. Usually, you just sell the business. If you have control, then you can sell the business through a trade sale to a strategic or another buyer, and you can actually command a control premium. So exit has not been an issue for buyout firms. And that's why for buyout firms, the market at this particular point is very attractive because valuation has come down. And there's lack of capital, there's dearth of capital. And I thought that AI will never be as intelligent as people because AI cannot set objectives. AI cannot imagine things. AI is very good at achieving objectives set by humans. But I also recognize that AI is a very powerful tool. I have seen how AI has improved so much to specialize in AI. You would think that if you use a lot of AI, then you don't need a lot of investment professionals, right? Because AI would do a lot of things that people would do. In our particular case, we have increased our headcounts. We have not decreased our headcounts.
Okay.
And I have not seen a noticeable impact on our investment decisions. You still have to make judgment, which is, I think, the most important factor for investment success. I think AI can make you much better informed. AI would help you write a memo more efficiently. But when it comes to investment, you need to be able to use all the experiences in the past to make the right judgment. So I think AI has a lot of potential. But to what extent it's going to help with investments, especially private equity investments, I think time will tell.